We've seen it time and time again. And I'm glad Adrian brought up 2004, 2005. I think that's the clearest example where gold did extraordinarily well in a tightening phase. And it was exactly that, behind the eight ball. So directional change does matter. If rates become slightly less negative at that inflection point, I would imagine gold would take a hit.
I'd like to get your outlook on the gold price. So bouncing off of Adrian's idea that once the Fed implements some sort of tightening, gold starts to react positively. First of all, do you agree? And if so, what's the timeline for gold price appreciation, given that the market's already pricing in a potential hike by March?
I would say, given history, this situation is sort of a sell the rumor, buy the news thing. We've seen it time and time again. And I'm glad Adrian brought up 2004, 2005. I think that's the clearest example where gold did extraordinarily well in a tightening phase. And it was exactly that, behind the eight ball. So directional change does matter. If rates become slightly less negative at that inflection point, I would imagine gold would take a hit. But the reality is that rates would still remain profoundly negative. And in that context, I can't see gold really tanking. I mean, people talk about going back down to 1,000 or whatever. As long as rates remain substantially negative, I don't see that happening. So I'm not too worried about gold. Actually, but rather than get into more forecasting, I think we've done a lot of theory here, but we've lost sight of the question of what to do.
Yes.
And so
what to do? All right, let's go back to that.
Couple things.
What to do?
Let's run down a couple of ideas there, and then maybe Adrian and I will have some differences. But so, for example, depends on what your goal is and your time frame. I say I'm not an economist. My expertise here doesn't come from having studied inflation for 50 years in universities. It comes from having lived in third world countries that have been through it. It comes from being in places where they cut the zeros off the money repeatedly and seeing what that does to people who hold on to currency units. And having something real, in my case, silver, literally saved me. And it literally enabled me to feed my family in a time of great duress in a currency that had suffered multiple devaluations. And I've seen this in more than one country. So I have very, you could say, visceral feelings, a visceral response to this. But obviously, nobody knows what's going to happen next month. If I say gold's the best inflation hedge, buy gold now, and next month the direction changes and gold drops $200, people will say, Lobo, you told me to buy gold and inflation's high and gold went down. You beep, beep, beep. So the time frame does matter. If you're forced to liquidate at a time when anything you put your money into as an inflation hedge is down, you're in trouble. So, time frame, risk, there are a lot of variables here. But let me just tick off a few things. If you have money that you're sure you're not going to need for a while, then I see gold and silver as a great way that combines liquidity with
physical gold and silver.
Value.
You're talking about futures, ETFs. What are you talking about? Bars?
I'm talking physical bullion.
Okay.
Bullion.
All right.
Yeah. Absolutely. Thanks for the clarification. I mean, I want to hold it in my hand. As Doug Casey says, the financial asset that you can be long for which there is no short, right? So I see that as the greatest combination there. But that's not the only thing. If I need cash, I need to hold something that's more nearer to cash, and that if I am forced to sell when prices of commodities are fluctuating isn't going to hurt me. But probably tips might be better.
Yeah.
But the problem with tips is that they are indexed to CPI. And as we've been discussing, CPI is a load of dingo's kidneys. So, in the real world, I'm still taking a loss with tips, but at least my principal is protected, and at least I get some offset against inflation. So that's maybe the lowest risk way to go for high liquidity funds. But, hopefully we don't have to have that much high liquidity. Real estate is much more difficult. I mean, real estate is great. I love real estate. I'm working on growing my real estate empire, but it's not liquid. It's not something that I think of as savings. It's something I think of as sort of broader wealth preservation. Maybe the best idea, this is not mine, but I've heard it, and best depends on how you look at it again, but maybe the best idea is actually to take on fixed rate debt. If you take on fixed rate debt at a level that you can manage, that, if you had to repay, you could, and inflation is higher than the rate that you're borrowing at, you win. Like you actually win by taking on fixed rate debt at a rate that's less than inflation and less than probable inflation. But you're still taking on debt. You still, if something happens and you need to repay that debt, there's an issue there. If there's a penalty for early payment, there's an issue there. So there are a lot of ways to try to manage this. And I guess my bottom line is don't get too clever. Like you can think of some clever debt mechanism that's going to combine liquidity with a not a carry trade, but a differential between rates that guarantees you a win against inflation. But then what if inflation goes lower than you thought? And now you've got this debt at a rate that's higher than you thought. So there's no silver bullet here is the bottom line, which brings me back to my favorite balance of risk and reward for long-term wealth preservation, not immediate volatility. I like the monetary metals. And yes, Darth Silver here. I do prefer gold over silver because it doesn't tarnish. It's more compact. It's more convenient.
Okay,
that's how I say.
I'll give Adrian a chance to. I'll give Adrian. Thank you, Lobo. I'll give Adrian a chance to respond, and we'll close it off there. So, what would you do to protect yourself against inflation?
Yeah, well, first of all, I agree with what Lobo said, and a lot of his introductory points are very important. And one of the most important points is he mentioned liquidating when markets are down. One of them is, and this is a tangent, but if I may, I think it's important. In my 40 years managing money, the primary mistake I found from the people who give me money to manage is that they want too much money in one asset class, and they go overboard, and they even borrow money to buy gold stocks. And if I knew they were borrowing money, I wouldn't let them, but they do it without telling me. And let me just say this: the worst possible thing in investing is when you're in the right sector at the right time, but then something goes wrong, you have to take some money out. It might be a margin call on a gold stock, but you have to take money out. Let me tell you, 9 times out of 10, if you have a desperate, urgent need for money, it will be at the wrong time. It will never be when, Barrick's just added 25%. It'll be when XYZ is down 25%, always. So, I think the first thing I would say is, we haven't talked about this, but get out of bonds, particularly treasuries, other than tips. You just don't want to be holding bonds in a situation, in an inflationary period. So that's the first thing, is what you shouldn't buy. And that's the first thing. Secondly, gold and silver, physical gold and silver. I agree completely. Physical gold and silver would be next. They are the surest, as I said earlier, they are, in my mind, the surest hedge on inflation. They won't necessarily be the best performer, but they are the surest. Gold stocks also, because other than extraordinary situations, if gold goes, up 20, 30, 40, 50%, the stocks of the companies that produce that metal will also go up. So gold stocks would come next. Commodities would come next. I'm very selective on commodities, but, which commodities I like and which I don't. But certainly buying commodities. Now, again, as Lobo said, you say something today and tomorrow something happens and people say, oh, he doesn't know what he's talking about. Let me just say right now, today, Friday morning, I've been trimming some gold positions for some clients, and I have certainly not been buying the commodities. I want the commodities to come down a little bit before I buy them, which might happen if Ukraine flares up. But that's a very short-term thing. But I just want to be clear that the price you pay does matter. But I think those are basically it. Debt, I'm averse to debt, period, and I think Lobo probably is too. But certainly, I had a client the other day call me. He's got a 3.2% 20-year fixed mortgage, and he's got a bit of cash. Should I pay off my mortgage? I don't think so. I mean, it's fixed rate. I mean, you can't get money that cheaply. And certainly in an inflationary period, you'll be looking at that and just thanking the stars that you have that debt, so long as you can afford to pay it back, obviously. But anyway, that's basically it. Gold and silver first, gold stocks and commodities.
Anything you disagree with there, Lobo? Were you guys on the
No,
same page?
all good.
Okay.
I just want to reiterate, don't get too clever. I mean, perhaps if you're a professional, you do this 24/7 and you have access to all the latest Bloomberg terminal data and you can engineer something. But most of us, just don't get too clever. Keep it simple. I'll leave the last word there, and I think you'll do well.
Let me just ask you one final question. We'll end it here. So, allocation of your portfolio into inflation hedges, whatever you deem to be an inflation hedge, versus allocation into something that is risky, that has more capital appreciation. How would you position yourself, basically defensively versus cyclically right now? Adrian, I'll start with you.
I'm going to give an extreme answer. I think 40 or 50% in gold and silver, and as much as 25% of that in physical is the right proportion, for me. And the reason for that is we've talked about inflation hedges. Now, supposing something happens, some catastrophe happens, and the markets crash and the economies crash and everything, goes to H in a handbasket. What assets are going to do well then? Well, bonds will do well, government bonds, but you don't want to be in government bonds. But gold will also do well in that situation, whereas copper and, oil will not. So the beauty of gold is that it does well in an inflationary period, holds its purchasing power in an inflationary period, but it also does particularly well in a deflationary situation that is accompanied by crisis. And I think if we move into a deflation at this point, it'll be a crisis.
Okay. I wish you had started with that sooner. That would have been a good headline, but okay.
All right. But actually, let me throw one more thing in there. So portfolio allocation, 50 is pretty rich, but in the current environment, I think that's actually de facto more or less what I have. But the one thing none of us has mentioned that I'll add in here is actually uranium. And uranium is not an inflation hedge, but in this particular market right now, I'm very bullish on uranium. Absent a major nuclear incident, it is the only commodity that is still below the cost of mining the stuff for most of the producers. So if you're looking for a value investment or speculation these days, as well as something that is, it's real, it's necessary, the government can't print it, I think you ought to consider uranium.